Morgan Brennan reports now on Chevron's financial pain.
Chevron reporting its first quarterly loss since 2002. As oil prices collapsed to the lowest level in over a decade, the U.S.'s second largest energy company saw earnings plunge more than 75% in 2015. The lion's share of losses came from the upstream division, which explores for and produces oil and natural gas. But during the fourth quarter, results were surprisingly weak in the downstream segment as well, as refining operations also saw profit tumble. After slashing its 2016 spending forecast 24% last month, CEO John Watson reiterated plans to cut costs, including reducing the company's workforce by 10%. Chevron also hopes to sell up to $10 billion in assets through 2017, after shedding $6 billion worth last year. But as the company braces for oil prices to remain lower for longer, Watson again stressing that the company's, quote, #1 financial priority is to maintain and grow the dividend, which currently yields 5%. After last quarter, analysts questioned just how long Chevron can pledge to do that. But Watson insists it's kept a strong balance sheet just for times like this.
Cash flow, as you can see by Chevron's performance today, is tight. They're going to have to borrow money this year if prices don't improve and if they want to maintain that dividend. But given the growth projects that they have in store for the next 2 or 3 years, it's a nice balance between growth opportunities and the ability to pay that dividend.
As the first of the major international oil companies to report, Chevron's miss could be a harbinger of more tough news to come. When ExxonMobil, BP, and Royal Dutch Shell report next week, the same factors will be in focus: plunging upstream profit, the resiliency of refining operations, and assurances that dividends will remain intact. For Nightly Business Report, I'm Morgan Brennan.